Welcome back. In this video, I'm going over 7 tax saving tips for 2024 and 2025. Now, the first 4 of these are pretty basic, but they're ones that often confuse people and people often don't really understand these. So this is the starting point. Before you go hiring people that are promising to save you taxes and trying to take advantage of loopholes and strategies, watch and learn about these 4 tips, okay? Because they're huge to saving taxes and just giving you peace of mind and clarity about your business finances and taxes. If you're new here, my name's Amanda. You're watching The Business Finance Coach, where I simplify money to help you succeed because I believe the world needs what you have to offer. I'm the creator of the Master Your Accounting and Taxes program, which helps business owners end dread, overwhelm, and confusion around their business accounting and taxes. And we do this by helping you get organized using our unique spreadsheet templates and training program so that you actually understand your business, your finances, and accounting and taxes. Now let's jump into the 7 tax saving tips for 2024. Okay, number 1 is a complete accounting record. Now, what is a complete accounting record and why does this help us with saving taxes? A complete accounting record means you're tracking every transaction related to the business finances. This can include, bank accounts, loans, credit cards, liability balances, transfers, investments you make in your business, and of course, the piece that everyone knows and cares about, income and our expenses. That tells us our net profit in the business and how profitable we are, right? How much money did we make over a period of time? Now, all those business expenses, these are our tax write-offs. So our accounting record is the starting point for taxes. So when people aren't keeping a complete accounting record, they're often missing various business expenses. That's why this is the number 1 tip. Getting a real solid accounting record often saves people taxes, let alone the stress and headache in and of itself. This way, come tax time at the end of the year, you're not scrambling trying to grab your sales from your payment processor, your expenses from this credit card and this bank account, and piecing things together, right? Maybe you have some stuff in QuickBooks, some stuff in this software, and you're trying to piece everything together just to get your taxes lower. No. With a complete accounting record, you have everything ready to go, and you've had it ready to go all year. So the IRS says for business expenses to qualify as tax write-offs, they need to be ordinary and necessary for your type of business in your industry. But this is pretty lenient. As long as you wouldn't be spending money on this thing if you didn't have a business and it's not personal in nature, your spending, it's going to qualify as a business expense. So this complete accounting record might be something like QuickBooks or an accounting software if you're using it properly to account for everything. Or in my Master Your Accounting and Taxes program, we use a really unique spreadsheet, but is still a complete accounting record. So for example, these business expenses may include things like supplies for whatever you're in the business of doing, office expenses if you have an office, printers, papers, pens, file folders. It might include software, might include assets like a computer system, speaker system, equipment based on whatever you do, real estate if applicable, marketing costs, advertising costs, the cost of hiring people to work for you, either as employees or people you pay as contractors, fringe benefits that you pay workers who work with you, research and development, training costs, and more. Now, this will lead us into number 2 for our tax write-off tips. So number 2 is some of those business expenses that we just talked about will have additional rules through the IRS for how to calculate the deduction and what you are required to keep track of so that if you're ever audited, you qualify to take the deduction. Now, this little area of tax write-offs is often completely missed for smaller businesses because when you're paying for lower cost tax services, they're just going to ask you questions and trust that whatever number you give them is right. And they really don't have the time, and they're not being compensated to educate you as a business owner. Now, it's not your fault. It shouldn't be this way, but it's the way it is. And that's exactly why in my Master Your Accounting and Taxes program, we have a tax write-off template covering a worksheet for all of the big tax write-offs that require special rules through the IRS. Now, some of the big ones are assets. So for example, this could be things like computers, like equipment, like real estate. So you don't get to deduct the full amount that you pay immediately. And instead, because you use these assets over time to make money, there's special ways that we deduct them. Another one is business use of a personal vehicle. So if you own your vehicle personally, but you're using it for business, there are special rules that allow you to take a write-off, but you have to track certain details. Likewise with a home office. So because your vehicle and your home, if they're owned personally, they wouldn't normally qualify for a business deduction, but we have special rules that allow us to do so. And another one would be health insurance. So those are some big tax write-offs that have special rules over at the IRS for us to deduct. So how you deduct these special tax write-offs does vary based on your type of business, whether you're sole proprietor, LLC, elected s-corp, or c-corp partnership. Okay, number 3 for our tax saving tips is paying quarterly estimated taxes as you earn income in your business. So our tax system is called a pay-as-you-earn system. This is why when you're paid as a W-2 employee, your employer has to withhold taxes for you, right? But when you work for yourself or you have your own business, you might still need to pay in periodically. Not out of every paycheck you take, but instead there's a calculation called quarterly estimated taxes. Now, paying on time according to the quarterly estimated tax requirements allows us to avoid penalties and interest. Now, I have an amazing video, The Ultimate Guide to Quarterly Estimated Taxes, that goes into detail into this, so I won't go through it here. But paying as you go can really save, stress and time and money. And while there are some solutions out there, tax preparers tend to give us things called vouchers to pay quarterly, and there are softwares where we can run a calculation. Unfortunately, these strategies tend to focus on if income is earned uniformly throughout the year. But many of us small business owners don't earn income uniformly throughout the year. And that's why I have a really unique spreadsheet template that calculates your quarterly estimated taxes. The cool thing about learning to run this calculation with our spreadsheet each quarter is that you can really understand the tax calculation, which can just help end some of the confusion. Since this is probably something we're going to have to do for the rest of our life, we might as well kind of break it down, learn a little about it, and get some clarity. And along that lines, the 4th tax tip for saving taxes in 2024, that's a basic that applies to everyone, is called the Qualified Business Income Deduction, otherwise known as the QBID deduction. This is a huge deduction. It's 20% of what's called pass-through business income. Now, this deduction is pretty standard. It's on your personal tax return, and we account for it in that quarterly estimated tax spreadsheet that I was just telling you about at tax tip number 3. And I have videos that go over this deduction. But to sum it up really simply, you take your income and you get 20% deduction. Now, it's taxes, so it's more complicated than that. But as long as your business net income, which means income minus expenses, is below these threshold numbers based on your filing status, whether you're single or married, then you're basically going to qualify for this deduction. Now, like I said, there's nothing that simple in taxes, so you can check out my other videos if you want more details on it. But you can check your tax return, whether you pay someone to do your taxes or you do it yourself. I show you how to do them yourself using Free Tax USA. You can check right here on your tax return to see that you're getting that deduction. So number 5 on our tax tips is electing S-corp status. So the S corporation is an election, and you can see on my cheat sheet here, it's not a legal type of business. You have to already have a legal type of business like an LLC, partnership, or C-corp. Then you can elect S-corp status at the IRS, and this allows you to be taxed a little bit differently. And this differently can save you some taxes if the amount of net income that your business has is substantially more than what you could pay someone to replace you, or multiple people, different jobs, to replace the work that you're doing. If there's a big enough gap there between the net income of the business and what you could pay someone to replace you, that is one way that you can save taxes with the S corporation. However, there are plenty of reasons not to elect S-corp status. You might have seen people advertising about saving money with the S-corp election, but to be honest, you really have to run the numbers and calculate this concept of reasonable compensation for your business. And I do have some tools that show you how to do this. And I have some YouTube videos you can see here as well. If money is really tight in your business, it's probably not going to be advantageous for you to do this. If you have some leeway and are able to be saving money, then it may be worthwhile. If your income is extremely low, I would not recommend looking into the S-corp at all, especially because that qualified business income deduction we talked about on the last tax tip, you end up losing that for a big chunk of your S-corp income. I'm not going to go into details in the calculation in this video, but check out those other resources for more information. And I have a special offer to get my spreadsheet that lets you actually calculate this for your specifics so you can see if this is worthwhile. If you do have an S-corp already and you aren't paying yourself as an employee and taking all these extra setup steps, then the S-corp could really end up costing you money. I see this happen a lot, and that's exactly why I made my program, the Tax Saving Strategies with the S-corp, so that you can be sure to save taxes and not accidentally end up costing yourself money with the S-corp. Okay, number 6 on our tax saving tip is the Augusta rule. Now, the Augusta rule is a strategy loophole to save taxes. However, I have a video going over this, and I'm just gonna come out and say it nice and simply. This is not worth most business owners' time at all, in my opinion. The Augusta rule was created for an event that happened in Augusta, Georgia, where there was a big golf tournament happening. And the IRS basically made a rule that if you rent your home out for 14 days or less, then you don't need to report the income and expenses as rental income and expenses. Now, this is really because of the administrative burden isn't worth it to the IRS, that it's better for it not to be reported that way. However, what people have come up with, tax preparers have come up with, is that you can rent your home to your business, not report the income personally, and deduct it as a business expense. Now, first of all, what valid reason would your business rent your personal home for? Just fill me in on that. If it applies, great. And maybe there could be some circumstances where this does work, but for most people, this does not work. The other thing is, if you have a home office, you don't qualify for this. Number 3, even if you do rent your home, what's the going rate and what percentage of taxes are we talking about saving here? Like a very small amount. And there's also the related party rules, which say that if you're paying someone and they're not reporting it for income, then you can't deduct it. So I personally think that this loophole is a waste of time. However, I do agree that there could be some specific types of businesses where this might work out. Okay, and number 7, our final tax saving tip here is called hiring your children to work in your business. So if you have a legitimate reason to hire your kids, this can be a great strategy, a great way to save some money since you're going to be spending the money on them anyways. You do need to genuinely hire them and have a system for paying them. And to be honest, I'll just jump to the point that if you're not already doing payroll for other employees or for yourself, if you have a C or S-corp, then the payroll aspect of this might make it not worthwhile. But if you do have employees or you're paying yourself, then I think this can be a great strategy if you have, a genuine need to hire your children. And it can save taxes because number 1, they're in a lower tax bracket and they probably have lower income. So for a few reasons for how the tax calculation works, the income tax they pay is going to be nothing or far less than what you pay. Plus, for minor children, there are rules that allow you not to pay FICA taxes, Social Security, and Medicare. So I have a video that breaks this all down, shows you examples, exactly how much money you can save. You're not going to save hundreds of thousands or tens of thousands of dollars, but it could be a little chunk of money that could really make sense. Okay, and that's all for our tax saving tips and strategies. Just to recap, the first one we had was a complete accounting record because that's our starting point for taxes. We need to track everything related to our business, income and expenses, and all of those expenses, any cost to earn that income to run our business is going to be a starting point for a tax write-off. Number 2, some of those tax write-offs, have special IRS rules and things we need to track to be sure we get the maximum deduction and have the information we need to properly calculate the amount and pass an audit if we were ever audited. Number 3 is paying quarterly estimated income taxes as you earn so that you have no penalties or interest or surprises come the end of the year. Number 4 is the qualified business income deduction, which is a 20% deduction of income. So that was the first 4 for our basics. Number 5 is electing S-corp status. Number 6 was the Augusta rule. And number 7 was hiring your children. So all the resources that I've referenced throughout this are linked down in the description box below. If you enjoyed this video, I'd love to hear from you. Please give it a like or a comment. And if you have any questions, I'd love to hear your questions in the comments down below. Otherwise, if you enjoyed this video, consider subscribing and I'll see you next time. Bye.